Hello, everybody. Ed Yardeni here. It's August 4th. It's the dog days of summer, but actually the past few days have been wonderful days. Very, very comfortable here in Long Island. I hope it's comfortable where you are. I'm looking at the participants that we've got, and from what I'm looking at, it looks like we've got quite a few people on vacation, which is kind of consistent with one of my hypotheses, and that is. Friday was August 1st. It's the beginning of a lot of vacations for a lot of people. And again, our turnout sort of corroborates that today. And I suspect a lot of people are a little bit burned out and decided that they didn't really want to be exposed to the market, especially on a trading basis. So looks like a lot of people sold on Friday, but they came back today. And they sold on Friday, as we know, for all sorts of reasons. I called it Freaky Friday in the quick takes. And the most obvious reason was that, first of all, it was August 1st, so that was Liberation Day part two. And the president basically imposed tariffs against everybody on the planet Earth. And so that was a bit of a disconcerting development, but certainly wasn't unanticipated. What was unanticipated was the shocker where the payroll employment data was very weak, only 73,000 increase in July, and what was expected was 100,000. But the bigger shocker was the big downward revisions, I think bigger than I recall happening in quite some time, but over 250,000 in downward revisions for May and June. And so the market really freaked out about that clearly. And then the president decided that he didn't like the data. He didn't believe the data. He called it fake data. He's anything that doesn't support his story is bound to be fake. But at any rate, he's the president, and he decided to fire the commissioner of the Bureau of Labor Statistics. That's a very unfortunate development. We all know that the BLS doesn't do a particularly good job at giving us the lay of the land on the labor market, but it's the best data we have available. And if anything, the president's reaction should have been, we need to give the BLS more money to do a better job of collecting the data so that we have a better idea what's going on there, and maybe we won't have such large revisions. Instead, he fired the head of the commissioner, who clearly has got a lot of credibility as a civil servant who's been there, I think, for 20 years, has gotten bipartisan support. And the commissioner doesn't exactly have any authority, power to change the numbers. If there's presumably hundreds of people working on those numbers, and then when all these numbers are compiled and put together, that's the data. That's the facts, as the BLS is able to discern. And you don't get a situation where the commissioner says, no, 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 I don't like these numbers, and takes an eraser, erases them and changes them. Besides, why would the commissioner do it with revisions? Why not do it with the original data? Anyways, it's all very perverse, but it is what it is. And there has been some significant blowback to the White House about what has happened. What else? Well, also on Freaky Friday, we had Kugler, a Fed governor, decide that instead of retiring, ending her term at the beginning of next year, she did it this week. I guess she wants to go on a nice vacation in August, or maybe she really thinks the Fed really needs to be lowering interest rates. So she obviously wasn't a dissenter. Whatever it is, she's going. And Trump said that this week he'll name a replacement for the commissioner of the Bureau of Labor Statistics, and he'll name a replacement for Kugler. And that replacement presumably would be the prime candidate for Trump to appoint as Fed chair. Everybody's going to know that. It could still be Chris Waller, I suppose. Anything's possible. Chris Waller's still at the Fed, will still be at the Fed, and is uh, taken the party line with regards to the White House, namely that interest rates should be brought down. But whoever is appointed to replace Kugler is the most likely candidate to be the next Fed chair. So in theory, you do sort of have a shadow Fed chair that will be at the on the FOMC. Everybody will know that. But again, it's a committee that has a lot of voters, and whoever is the Fed chair has to get support. Clearly, Fed Chair Jerome Powell did not get the support of two dissenters. They dissented and said so. And if the next Fed chair is too much of a loyalist and too much of a radical in terms of trying to push for lower interest rates to occur faster, sooner than the data confirms, there could be a lot more dissenters to the point where the Fed chair would actually be in the minority on a vote. So keep your seatbelts on. It's going to be interesting as we get into the new year. But I guess we'll have a preliminary indication of what this is all like in the September and December FOMC meetings, since there will be a Trump loyalist replacement for Kugler in these two meetings. And then, of course, Trump on his social media said that he didn't like what President Medvedev of Russia was saying. He thought it was too hostile, so he countered by saying he was moving a couple of nuclear subs. He didn't say exactly where he was moving them, and he didn't say whether they were nuclear powered or nuclear powered and outfitted with nuclear missiles. So a lot of pretty disturbing news on Friday. So the market went down, but I think it went down mostly on the payroll employment. By the time it had, you know, investors had taken their profits on their positions, some of these other developments only confirmed in their minds that it's time to go on vacation and cover some. On the other hand, the buy on the dip, the dippers didn't go on vacation, and they're back this morning doing exactly that, buying on the dip. Maybe they read my Freaky Friday quick takes. Maybe they read our latest morning briefing, which was titled "Relax, folks. The jobs data was okay." And let's have a quick kind of consideration of why the data was okay and wasn't as bad as was widely perceived. I think we've got two factors here. On the demand side of labor, there were some factors that obviously weighed on payroll employment and led to the revisions. On the supply side, there were some developments that have also reduced the supply of labor. And I think both of them together kind of explain and actually justify the downward revisions. Also, by the way, the downward revisions actually make sense in terms of the levels. I mean, they make more sense than the preliminary. If I was an employer in May and June, given what I've called Trump tariff turmoil, I don't know that I would have hired anybody. I don't think I would have fired anybody. A lot of uncertainty about tariffs and about what Trump's up to with regards to that. For a while there, remember all the excitement about the Doge and how we were going to have, numerous, lots of unemployment, job losses in the government. That really didn't happen. I think altogether, since the beginning of the year, job losses in the government, federal government, have been 68,000, which is not a terribly big number compared to 3 million people working at the federal government. But there was a lot of uncertainty, turmoil in May and June. Also, the stock market had a real dive right through early April, and people were still kind of a little bit shell-shocked about that, even though the market was clearly making a significant comeback. But again, I really don't have a problem with the revisions in terms of the levels. I mean, I don't like to see revisions that large because it does indicate that the preliminary numbers are useless, maybe even garbage. So, Trump's pretty good at recognizing problems, as he clearly did with the payroll employment numbers. There's a problem with them. But on the other hand, it's uh, very unlikely that it has anything to do the with politics, with partisanship, has everything to do with the BLS needing more money to do a better job to collect that data. So we'll see how that plays out. There's again a lot of pushback. We'll see how Congress responds to all of this, and we'll keep attuned to that. I think that now that well, who knows? Trump tariff turmoil seems to be abating, but then that was not necessarily the case on Friday. And then, of course, the courts may very well be about to rule, the appeals court may be about to rule that Trump really doesn't have the legal authority to do what he's done with tariffs. And the appeals court has 11 judges, and we'll see how many of those judges rule against Trump. If 11 judges rule against Trump, then the Supreme Court might say, you know what, we don't really need to consider this case at all, and that could really put everything into make things even messier on the tariff side. I mean, if I'm running a business and I paid a lot of duties for Trump's tariffs, I'm going to send a letter to the Treasury and saying, when are you going to send me my rebate check? Because you didn't have the authority to impose these tariffs. Then again, there are other ways that Trump could impose some of these tariffs, but they take longer. They're a little messier, and so it's not clear that that's the way he'll go. Look, we're getting close to the midterms, to the electioneering for the midterms. Trump should be starting to put together a schedule of sports stadiums, auditoriums, where he's going to have these rah-rah rallies for the Republicans. They have a very thin majority in Congress, and he's got to make sure that they keep the majority. If he loses the majority, he could wind up getting impeached again. So he certainly doesn't want to go there, and he certainly would like to have four complete years where he's got enough support in Congress to continue to push his programs through. So that's something to be considered. But I think that if I was an employer and I needed to expand, I would start to do that going into the fall, into the end of the year, especially recognizing that there's a real shortage of labor there. And the labor supply is measured by the labor force. That's actually been flattened down this year. And again, has something to do with Trump policies in the immigration area. He's been very successful, very effective in shutting the border to illegal immigration. And they've been, I guess, fairly effective in their deportation efforts. And that's bound to be having an impact on the supply of labor. Now, here's the really good news for you. I don't think the pessimists really pointed this out, but real GDP in the second quarter was 3%. Now I know that was a preliminary number, and maybe that will get revised down, but that's what we have right now is a 3% increase in real GDP during the second quarter. And at the same time, we just had a downward revision in the last 2 months of the second quarter to payroll employment, downward revisions of over 250,000 for May and June. So that's bound to have a positive impact on productivity, for whatever productivity was going to be. And it was going to be a good number because honestly, we have to take the first and the second quarters in combination because of all that, the distortions created by imports during the first and second quarters. And we know the productivity actually fell 1.5% during the first quarter. So the arithmetic of this bounce back is it probably bounced back by 2%, but who knows? Maybe it's more like 2.5%, depending on how these revisions get factored into the productivity numbers. And that would also help to make some sense of why, despite some of these tariffs being implemented, we really haven't seen a big spike in inflation. Productivity may be actually providing some sort of cushion there. But let's go and look at some charts that are related to all this. And so we're looking here at non-farm payroll employment, total versus private. So you can see that there has certainly been a slowing down in non-farm payroll employment gains, and the 3 month is down to like 35,000, 3 month average. The July number was 73,000. So things have definitely slowed down. And again, some of it is, I think, Trump's tariff turmoil led to a kind of a freezing of hiring, but without firing. So initial claims remained very low. The Challenger report on layoffs remained very low. Then a slight uptick. So maybe if all we knew was this chart, if this is what been the preliminary numbers, we would have been cheering the July numbers because it's a significant uptick from the two prior months, and maybe we'll get a further upticks up ahead here, which is kind of consistent with my view that a lot of this is temporary on the demand side. On the other hand, we also have the supply side issue, but then offsetting that would be productivity. This is the private sector, same kind of story, very weak in June, and then July was 83,000. And again, if these were the preliminary numbers, we'd probably be actually kind of happy that things didn't continue to be as bad as they were in May and June. This is right out of the employment report. You take payroll employment and multiply it by this, which is the average work week, which is a very volatile series. You could almost tell that if it's down 1 week, 1 month, it'll be up the next month, and so here we're back up again. But this was up 0.4% on a month-over-month basis. So total hours worked, aggregate hours worked, we're talking about $4.7 billion. Let's do that again. 4.7 billion hours is what was worked. That's back to a record or just slightly above the previous record. So we're basically at a record high in total hours worked. There certainly doesn't look like there's any particular problem in the labor market here when you look at it this way, and it does zig and zag a bit, but it's zigging and zagging in an upward trend, and I don't see that that's changing, and I certainly don't see suddenly a recession free fall in these numbers. And then average hourly earnings, all-time record high in nominal terms. I think they were up like 0.3% month over month for July. We don't have July CPI yet or the deflator data, but my hunch is that the 0.3 might still have beat inflation, price inflation. But you can see that real wages have been increasing that are not at a record high. There's a lot of funky stuff that happened back here, but take out the funky stuff, I think we're basically at a record high. Then if you take nominal wages and multiply it by this number, you get what we called our earned income proxy, which is a proxy for wages and salaries in personal income. So that's an important component of personal income. And guess what? It's up. And I think it's up 0.7%, right? I mean, aggregate hours worked up 0.4, average hourly earnings, wages up 0.3, and you get 0.7, which is a very healthy increase. And that definitely had to beat the increase in inflation during the month. So total real wages are increasing, which augurs well for various measures of consumption like retail sales ex food services, PCE goods, and so on. So that I hope I'm making you happier about these numbers. They weren't anywhere near as horrible as the market seemed to initially respond to. And this is real wages again. So it's average hourly earnings divided by the consumption deflator, and you can see that for low-wage workers, we have data on low-wage workers going all the way back here. And remember how progressives kept saying that Americans haven't seen a increase in their real incomes and their standard of living for decades. They aren't saying that as often now, but I'm sure they still believe it and occasionally say it. That was actually true in the 70s, 80s, and the first half of the 90s. But since then, the uptrend has been 1.4% per year for real wage increases, which is a pretty decent increase in the standard of living, and that hasn't really changed. We had, again, some funky stuff going on here, but we're actually growing above that trend line. The overall real wages total is here, which has also been continuing to trend higher. The laggards have actually been higher wage workers. Higher wage workers lost real wages. Their wages and salaries did not go up to meet the increase in prices post-pandemic, but now they are, so they're catching up a little bit. But the bottom line is real wages are essentially at an all-time record high. Here's another measure that came out last week, Employment Cost Index, total compensation. So this is wages, salaries, and benefits. They were up 4.2% at an annual rate, 3.5% year over year. And we know that the inflation has been up about 2.5%. So again, that's consistent with real wages increasing. And it's not just the rich, it's across the board. And as I just pointed out, lower wage workers actually have been seeing better gains since the pandemic than higher wage workers. This is an interesting thing to think about, and that is the JOLTS data has something called hires. We call it net hires, hires minus separations. Shouldn't that be the same thing as the change in payroll employment? I think conceptually it makes sense, and you can see that this is the job hires minus total separations. This is the non-farm payroll data. Again, it was up only 73,000, but that was pretty good compared to May and June. And so this is still this data lags, but June is still 144,000. Okay, compared to like below 20,000 for May and June. And so this is 144,000, and this one over here is 250,000 back in May. Let's see if these things get revised, but the JOLTS data suggests that the payroll employment news is actually better than has been suggested by these numbers. And they're both calculated by the Bureau of Labor Statistics. So, but I think I'm the only one who's figured out that hires minus separations might be an alternative way to measure what's going on in the labor market in terms of net payroll gains. And there is obviously a good correlation between the two. Not right now, but let's see how this thing gets spun out. Now, the labor supply and demand story, this is a chart that Fed Chair Jerome Powell particularly likes. And you can see that there has been a slowdown in demand for labor defined as household employment. Household employment measures people who are working, whether they have one or two jobs. Payroll employment measures more than one job or more than one jobs. So if we look at the demand for labor, which is people, this is household employment plus job openings, and Powell pushed job openings ahead by 1 month. Kind of makes sense. And so this is the demand for workers, 170.5 million workers. The supply is the labor force, and that's 170.3. So they've actually been, you can see that they have diverged in the past. In the past, the demand for labor was less than the supply. Here they got closer when the labor market really got tighter. And here again, you had a different situation where the demand for labor way outstripped the supply of labor, but that has now come into equilibrium. And what do we have here? We've got a story where some of the weakness in payroll employment is demand related, and again, it might be uncertainty related to Trump's tariff turmoil. And some of it is supply related. Again, some of it related to Trump's migration policy. So Trump may be very upset about these numbers, but they very well may have a lot to do with his recent policies. That doesn't mean that the labor market isn't still resilient and it won't show better growth. And if it doesn't show better growth, we're going to get better productivity. And Trump should have kind of jumped on the revision and say this means that productivity is making a huge comeback, and nothing. What could be better for the roaring 2020s than a productivity-led economic boom? Here's the productivity numbers. As I said, they were down, and they should be up by at least 1.5%, and it could be down up to 2.5%, based on the revisions in the labor market. Clearly, we're not seeing layoffs. This is the Challenger layoff announcements. This is initial claims. What we're seeing is that the duration of unemployment is increasing. People are finding it tougher to find a job when they're unemployed. There's an article, I think it was in the Journal today, one of the financial media, very good article about how younger people coming out of school are having a very difficult time finding jobs, and some of that may very well be related to AI, to artificial intelligence, performing tasks that young entrants into the labor market might have done in the past. So this is something we're thinking about that needs to be considered. Uh, I mean, AI is all about brain, whereas the previous technology revolutions were all about brawn, muscle, and making things happen faster, less things to carry, move things faster. The the data revolution with the AI component now is all about brain, and maybe a brain revolution does in fact create more unemployment or more duration of unemployment. Um, what else? Well, this is interesting. Teen unemployment is really where we have the problem, but the adult unemployment is still 3.8%. So the adult labor market looks fine, and it may very well look. Let's face it. I mean, teen unemployment has been extraordinarily low during post-pandemic, and now maybe it's simply normalizing, and it's nothing particularly to worry about. I think some of this is Shake Shack. I like Shake Shack. I go into Shake Shack, and instead of having a whole bunch of people there, they have one person behind the counter, at least to the one I go to, and all these iPads, and you put in your order, take a number, put it on your table, and then one person comes out from the kitchen and delivers it to you, and that's it. So they don't have as many people working, taking orders and things like that. Um, I recently parked my car in New York City and pulled into the parking garage, and the attendant pulled out his phone, put in the license number, asked me what my phone number was. He texted me the information on my car with a link to that allowed me to let them know I'm coming and to pay for it. So again, you don't need a cashier. So some of these jobs that are in fact being replaced by not AI necessarily, just by using the automation, things as simple as the iPad. So again, the economy looked. There's obviously areas of weakness in the economy. The manufacturing PMI was down. The On the other hand, the regional looked like it was improving. Manufacturing kind of still doesn't look like a area of a lot of growth. But I don't know. I don't think this is really capturing manufacturing of semiconductors and servers and computers. Some of that happens in the United States. It's not all done from overseas. Some of it is assembled. So what is the Fed going to do? Well, good question. We may get a few of them giving speeches saying that they're converting to to the Waller-Bowman camp, saying, we need to move ahead here and lower interest rates. I mean, Trump could certainly continue to bash Powell, say he's too late. See these employment numbers prove that I'm right on all this. Undoubtedly, he'll do that. But on the other hand, I think we aren't done with the tariffs having an impact on inflation. And for those who say they can't discern any impact, look at all these components. Oh, what did I do here? I got the wrong figure in here. Okay, I'll fix that. But there was a whole nother chart that should have gone in here, and I'll put it into a quick takes. But I have a chart of all the durable goods that have a lot of imports going into them. Yeah, I don't know how we messed that up. Anyways, we did. And so we have a chart showing that a lot of durable goods, and even non-durable goods that are imported are in fact showing some pretty outsized increase in prices during June, and we may get another example of that in July. So I'm still kind of sticking there with the none and done, even though the Friday's number convinced everybody that the Fed is about to lower rates. But we'll see how that goes. For the stock market, I guess heads you win, tails you win. If the economy is weaker than I think, well, the Fed will cut rates. If the economy is better than consistent with our view, then we won't get a Fed rate cut, but the economy will still look pretty good. In any event, the market may kind of churn here for a while, as it typically does in August and September, and perhaps set us up for a year-end rally starting sometime in October. But anything is possible here, but anything's possible. I put my bets that this is still a bull market. All right. We got six Qs. Let me give you six A's. Let me put on my reading glasses here. Uh, and by the way, informed sources tell me that my work on the labor market, as we just discussed, might actually be getting some attention at the White House. I wonder why. It says the title is "Relax, Folks. The jobs market is okay." So I guess that has some appeal to some people in the White House. But let's see what we got here. So, okay, since tariffs are not set, they seem to be migrating. Migrating. Companies are delaying decisions on hiring and investment. I realize we are in balance, and other parts of the economy's services are picking up the slack. How long can this go on without economic downside? Um, how about through the end of the decade, the roaring 2020s? That's been my premise since 2020. And so I think the economy remains resilient, notwithstanding the Friday numbers. Obviously, I've had to do some really in-depth analysis of the numbers, and I try to be objective about these things, though my optimistic bias just keeps pulling me in one direction. But I try to keep myself on a straight and narrow and honestly objective. And objectively speaking, I think the economy is proving its resilience uh, some more. Michael, even if the weak jobs data are related to labor shortages, doesn't that imply very low GDP growth ahead due to lack of employers to support company growth and expansion plans? Michael, thanks for asking. And the answer is the one I gave you before, and that is productivity. Uh, that's really been our story for the roaring 2020s, that a uh, technologically led innovations uh, boost productivity. And so maybe let's say labor force growth is only 0.5%. If we have no increase in productivity, then real GDP is only 0.5%. The recent trend is past 5 years, actually, the average increase in productivity has been 2%. So 2 plus 0.5 gets you where we've been, 2.5% on a year-over-year basis. We've been there for a few years. And if we get from 2.5 to 3.5%, the full percentage point increase in uh, in productivity. Let's do that again. 2 to 3%, then you get 3.5% real GDP growth. So productivity is fairy dust. It makes everything better. So you either believe or you don't believe. I believe, and I believe based on the facts that productivity has been making a comeback, and we've discussed that many times in the past. Cagdis. Hi, Ed. If the federal courts conclude between now and early September that IEEPA tariffs are invalid, how do you think stock and bond markets react, all else equal? I've been thinking about that, and I'm not quite sure. My hunch is that if Trump kind of backs off and says, we got to move on to other things. This is not going to work for us. We got to focus on our successes with the border. The economy's not doing so bad. If you look at real GDP, I think he's going to have to turn to the midterm elections. If that's the case, then maybe he'll kind of won't be as adamant about tariffs. I mean, he'd love to just have a 15% tariff and bring in 400 to 500 billion dollars and end his story. Maybe he can kind of figure out some get the Congress to pass a 15% tariff across the board. It doesn't look like many of our trading partners really object to that and feel like that's a game changer or a killer for them, since they recognize that Americans are mostly going to be the ones paying for it. So my hunch is the stock market would rally on it. The bond market might not, to the extent that we don't get the revenues from the tariffs. Nick, can you comment on the BLS business birth death model, which seems to have led to the major employment revision last year and this year? I understand that this model was revised a few years ago and is vulnerable to overestimating the number of new jobs created by new business versus the past new businesses are smaller. Apparently, the model results are not reviewed monthly, and therefore adjustments can accumulate and become material. It's a good question. It's another example of kind of how messy it is the process of calculating the employment numbers. But I think my response is I look at business formations, applications for businesses, and they remain very strong. So I'll write up some more about that. I'm overstaying my welcome here. Let me take one more question. Is there any way to determine the impact of AI in corporate employee demand levels? I don't think at this time you can put a number on it. I think it's got to be very, very anecdotal. Well, with that, thank you very much. If we didn't have skin in the game, this would just be a laugh a minute. It would be lots of fun watching, kind of like living in history as a disinterested and unimpacted observer. But we're not that. We're all involved. We all, one way or another, get affected by all these things. But the stock market's telling us we're going to be okay. And I'm telling you, we're going to be okay. Thank you all very much. Oh, by the way, I'm taking a vacation next week, going to the United Kingdom with my wife, going to the Cotswolds, and I understand JD Vance is going to be there with his family. So we'll see if we run into each other. So I won't have a webinar next week, but I will the week after that. Thanks, everybody. Have a great couple of weeks until we catch up.